straight to it. Dropbox. On the surface, the company just put out an earnings report that looks absolutely phenomenal. We're talking record-level profits, and they're generating a massive, almost unbelievable amount of cash. Now, by every conventional measure, a stock with numbers like these should be soaring, right? It should be a darling of Wall Street. So can someone please explain why this stock is getting hammered, hitting lows we haven't seen in years? Something is seriously wrong with this picture. Today, here at Iron Financial, we're not just looking at the headlines. We are forging a deeper analysis, cracking open the financial statements and running the numbers ourselves. We're going to figure out once and for all if Dropbox is a solid as a rock financial fortress or if it's just a cleverly disguised value trap waiting to snap shut on your portfolio. Let's get into it. And this right here, this is the entire conflict, the puzzle we have to piece together today. You look at the financial news and the headlines are practically yelling at you. Dropbox crushes Q4 earnings. It sounds fantastic. But then you pull up the actual stock chart, and it tells a completely different, much darker story. A stock that is just bleeding out, week after week, trading way below any meaningful technical level. So what gives? The market, you have to understand, is sending a signal here. It's loud and it's clear. It doesn't buy the story. It doesn't believe the hype. So the real question, the billion-dollar question, is what does Wall Street see that the average person looking at that headline might be missing? What's the reality hiding behind the spin?
That's exactly it. And look, to really understand the market's deep skepticism, you first have to do something that might feel a bit counterintuitive. You have to respect the bull case. You have to understand why, on paper, this company looks like an absolute beast, an impenetrable fortress of profitability. The arguments for owning this stock are compelling, and they are built on a foundation of cold, hard, undeniable numbers. So before we go looking for the cracks in the armor, we have to admire the armor itself. We are going to build the bull case, piece by powerful piece, and it all starts with their incredible execution on the bottom line. Now look at this. This isn't a one-off. It's not a fluke. It's not some clever accounting trick they pulled for one quarter. We are talking about 5 consecutive quarters, 5 in a row, where Dropbox hasn't just met Wall Street's earnings estimates, they've systematically demolished them. In this last quarter, Q4, they came in with an earnings per share number that was more than 14% higher than what the so-called experts predicted. When you see a pattern of outperformance this consistent, this relentless, it tells you one thing. This management team has ironclad control over their operations. They know exactly which levers to pull and precisely when to pull them to squeeze every last drop of profit out of this business. This is what execution looks like. And all of that fierce operational discipline, it translates directly into this number right here, a 40.6% non-GAAP operating margin. Now, for those of you not familiar, non-GAAP just means we're stripping out some non-cash or one-time expenses, like stock-based compensation, to get a cleaner look at how the core business is actually performing. So is 40.6% good? Let me put that in perspective. In the hyper-competitive software industry, a 20% margin is considered pretty good. You hit 30% and you're considered best in class. But getting over 40%, that is truly elite rarefied air. It means that for every single dollar of revenue that comes in the door, almost 41 cents drops straight to operating profit. This is the sign of a machine that is tuned for maximum efficiency. So what's the engine driving that incredible efficiency? It's this, an astounding 81.8% non-GAAP gross margin. This number tells us that the core service they provide, storing your files in the cloud, is just fantastically profitable. I mean, think about it from a business perspective. Once you've spent the billions to build out the massive data centers and the global infrastructure, the actual cost to serve one more paying customer is tiny. It's almost nothing. This allows them to just stack cash at an unbelievable rate. This is their economic moat. This is their competitive advantage. And you can see it is incredibly wide. And all of that elite margin performance, all of that hardcore operational discipline, it all culminates right here. Over $1 billion in unlevered free cash flow for the year. And let's be crystal clear about what this is. This is not some abstract accounting profit that only exists on a spreadsheet. This is a river of cold, hard cash flowing into the company's bank accounts day in and day out. This billion-dollar war chest is what funds absolutely everything they do. It pays for their engineers, their marketing, and, most critically for the bull case we're building, it is the fuel for their absolutely massive shareholder return program. From this angle, looking at these numbers, Dropbox looks completely invincible. Okay, you've painted a compelling picture. I'll give you that. The fortress walls are thick, the margins are world-class, and the cash flow is a torrent. I get it. It's a beautiful story. But here's the problem. A fortress built on top of quicksand is still a trap. And this entire bull case, this whole story of profitability, it completely and willfully ignores the single most critical life or death question for any technology company on planet Earth. Where is the growth? Exactly. Profitability is great. We all love profit. But in the brutal, cutthroat world of software as a service, there is one simple rule. If you are not growing, you are dying. Period. It's not simple. And let's be real about the competitive landscape. You have giants like Microsoft, Google, and Apple who are bundling massive amounts of cloud storage into their operating systems and productivity suites, often for free. The very ground is eroding beneath Dropbox's feet. They are a standalone, single-purpose product in a world that is moving towards fully integrated bundles. So for any serious investor, profitability isn't the real question anymore. The real question is about survival. Can this business even grow at all? And here is the brutal, unavoidable answer to that question. Just look at this chart. Revenue growth hasn't just slowed down, it has slammed into a brick wall and gone into reverse. For the full year, revenue was down. In the most recent fourth quarter, it was down 1.1% from the same quarter the year before. Let me be very clear. For a subscription business that lives and dies on adding recurring revenue, a negative top-line number is not just a bad sign. It is a five-alarm fire. The growth engine has completely and utterly seized up. And if you want to understand why that revenue engine is stuck in reverse, you don't have to look any further than this breakdown. Every single key performance indicator, every metric that truly matters for a subscription company is flashing bright, screaming red. First, look at the number of paying users. It's shrinking. They are actively losing customers. Second, okay, well, maybe they're making more money from the customers who are sticking around. Nope. Look at ARPU, average revenue per user. That's declining too. So let's connect the dots. You have fewer customers, and on average, those customers are paying you less money. The direct result of that toxic combination, a nearly 2% drop in annual recurring revenue, the absolute lifeblood of their business model. The entire model is misfiring. I hear you. The organic growth picture is undeniably bleak. The core business is stagnating, and that's a fact. But here's the thing. Management isn't blind. They are looking at these exact same numbers, and they know the growth story is dead. So what's their answer? Are they pouring that $1 billion of cash into R&D to invent a new product? Are they trying to make a big acquisition? No. Their answer is something far more direct, far more aggressive. It's a massive $1.7 billion bet on themselves. This right here is the main event. Let's just let that number sink in for a second. They spent $1.7 billion buying back their own stock. This isn't just some small line item on their cash flow statement anymore. This has become their entire corporate strategy. Now, the bull case argument here is that this is the ultimate vote of confidence. Management is basically telling the market that they believe their own stock is so deeply undervalued that the highest and best return on their capital isn't in developing new products or in marketing, but in buying their own shares off the open market. It's a very direct, very aggressive way to reward shareholders by shrinking the total number of shares out there. Confidence? I don't see confidence. I see desperation. This is the oldest trick in the corporate finance playbook. It's classic financial engineering. When you can no longer grow your revenue, the R in the earnings per share calculation, what's the only other way you can make that EPS number go up? You have to aggressively shrink the S, the number of shares. It's not creating any real, organic, sustainable value. It is financial alchemy. It's using billions of dollars to paper over the deep structural cracks of a business that has fundamentally run out of ideas for how to actually grow. And this, my friends, is the hidden cost of all that financial engineering. This is the part of the story they don't exactly highlight on the earnings call. The company's balance sheet has been utterly and completely gutted. Just look at these numbers. They have burned through so much hard cash on these buybacks that their stockholders' equity, which is essentially the book value of the company, has collapsed from an already negative $752 million to a shocking, mind-boggling negative $1.53 billion in a single year. This isn't building a fortress. This is selling the stones from the foundation just to pay the guards. It is a strategy that fundamentally weakens the company's financial core. So how do we quantify that kind of risk? How do we put a number on the danger of a balance sheet that's been hollowed out like that? Well, we use a tool that was designed for exactly this purpose, the Altman Z-Score. You can think of it like a financial stress test for a corporation. Its primary job is to combine several key financial ratios from the balance sheet and income statement to predict the likelihood of bankruptcy within the next 2 years. You don't need to know the whole formula. Just remember this one critical number, 1.8. Any score below that, and a company is officially in the distress zone. Dropbox isn't just in the distress zone. With a score of 0.33, they are deep in the sub-basement of the distress zone. That cratered negative $1.5 billion stockholders' equity that we just looked at, That is the primary driver of this terrifyingly low score. You don't have to be a Wall Street quant to understand what this means. This metric is a screaming red siren, an unmistakable warning that despite all that impressive free cash flow, the company's overall financial structure is dangerously unstable and carries a significant quantifiable risk of serious financial distress down the road. All right, we've laid it all out. We've seen both sides of this very conflicted coin. On one side, you have the magnificent fortress of profitability, built on elite margins and a torrent of cash. And on the other, you have this crumbling foundation, plagued by stagnation, a shrinking user base, and a high-risk financial strategy that has completely wrecked the balance sheet. It's time to weigh the evidence. It's time for the verdict. Is this company built on bedrock, or is it sinking into quicksand? Let's be honest, the bull case is seductive. It's so simple and clean. You've got these elite 40% plus operating margins generating over $1 billion a year in cash. The stock trades at what looks like a dirt-cheap valuation, a PE ratio under 14, and management is shoveling that cash back to shareholders with these huge buybacks. It just screams deep value opportunity. But then you look at the bear case, and it's absolutely terrifying. You have negative revenue growth, a shrinking customer base, a balance sheet that's been destroyed by those very same buybacks, resulting in a bankruptcy risk score that is profoundly alarming. The two stories could not possibly be more different. And you know, this single sentence from the source material, it just captures the entire dilemma, the fundamental choice that defines Dropbox today. Management is returning capital faster than it's growing revenue. They have made a conscious strategic decision, and that decision is to prioritize financial engineering over innovation and organic growth. They are playing defense with their cash, not offense. This isn't a strategy of building for the future, it's a strategy of harvesting the present. Which leaves us with one final verdict-driving question. Are they building a durable, solid foundation for the future, or are they just using billions of dollars in financial sleight of hand to paper over the deep, growing cracks in this business? Here at Iron Financial, after weighing all the evidence, our conclusion is clear and it is overwhelming. The lethal combination of a shrinking user base, negative revenue growth, and a high-risk balance sheet strategy makes this a classic value trap. That fortress of profitability might look impressive from a distance, but it is sinking into quicksand. This is not the kind of foundation you want to build a portfolio on.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.